Hey there, welcome back. In this lecture, we're going to go over gold and oil and how it affects the Forex market. For this, we'll look at a lot of fundamental analysis and some technical analysis. You should be already familiar with fundamental analysis. We covered that in the last lecture. First, we'll take a look at gold. We need to figure out which countries export gold and which countries import gold. The top 10 exporters of gold are Switzerland, Hong Kong, UAE, the United Arab Emirates, the United States, the United Kingdom, Australia, Canada, Turkey, Japan, and Thailand. The percentages are how much of the market is exported. And for the top 10 importers of gold, we have Switzerland, Hong Kong, India, the UK, the UAE, the US, Thailand, Canada, Saudi Arabia, and Germany. In a minute, I'll go over what to do with this information, but now let's move on to the exporters and importers of oil. For that, we're going to look at producers and consumers. The top 10 producers of oil are the US, Saudi Arabia, Russia, China, Canada, Iraq, United Arab Emirates, Iran, Brazil, and Kuwait. The numbers are how many millions of barrels per day are produced. For the top 10 countries that are the consumers of oil, we have US, China, India, Japan, Russia, Saudi Arabia, Brazil, South Korea, Canada, and Germany. Again, the numbers next to them are millions of barrels per day. Now, with these two categories, we want to find out which countries have more exports and which countries have more imports. So, the countries with more imports of oil, the US, China, India, Japan, South Korea, and Germany. The ones with the asterisks are the ones that are tradable, that are suitable for trading. And the countries with more exports of oil are Saudi Arabia, Russia, Canada, Iraq, UAE, Iran, and Kuwait. On this list, only Canada is suitable for trading. Based on this information, we would only be trading the Canadian dollar with either the Japanese yen or the US dollar. So in summary, when gold goes up, it has a negative impact on the US dollar and Swiss franc, and a positive impact on the Australian dollar. So when gold goes up, we expect the Aussie dollar, the Australian dollar versus the US dollar to go up, and vice versa when gold goes down. Now for oil, when oil goes up, it has a positive impact on the Canadian dollar and a negative impact on the Japanese yen. So we expect the pair, Cad Japanese Yen, to go up. And when oil goes down, we expect this Cad Japanese Yen pair to go down. You could also use the oil scenario with the US dollar CAD pair. When oil goes up, the US dollar CAD goes down, and when oil goes down, the US dollar CAD goes up. Now on to the technical parts. That would be, we were looking for discrepancies in these predictions. When the currency doesn't do what we expect, then we have a trading opportunity because we expect it to go back to doing what we do expect. To illustrate, let's put on a chart for oil. This is a 1 minute chart going from 9 a.m. to 12 p.m., a 3-hour window. This is the highest volume time of the day. This first chart is the oil chart. As you can see, it is in an upward trend. Now let's put on the Cad Japanese Yen chart. This is covering the same time span as the previous chart. As you can see, it does follow the uptrend that the oil had. Now let's look at the US Cad chart. Again, it's covering the same time span as the other two. This one is a little choppy before heading up eventually. That is a discrepancy, actually, the upward movement, and so we would look for it to drop soon afterwards. Now you can backtest this idea on your own and see how accurate it is, and maybe you can come up with a strategy for it that is profitable. It does make a lot of sense, both on fundamental and technical analysis, so do try it out. That's it on this lecture. In the next lecture, we're going to cover cross currencies. See you there.